There's about three main types of mining companies every investor should know about, and what these are could make or break your portfolio. Let's start off with the majors. The majors, as you might expect, are major mining companies. They're big, they're established, they're the ones already producing a lot of gold with established cash flow. They've got large cash reserves, they can expand their operations, they often pay a nice dividend. So that's a bonus. Think of like BHP, otherwise known as the Big Australian, or any other major mining company you might have seen in the news. These companies, they're like the blue chip stocks of the mining world. They're less risky, more stable, but just don't expect explosive growth. Speaking of explosive growth, now let's move on to the juniors. Now this is where things get really exciting. Juniors are smaller companies that live on the edge of discovery. Inside this group, you'll find explorers drilling for new gold, developers trying to bring projects into production, and project generators who specialize in finding opportunities and then partnering with bigger players. Juniors are high risk, high reward. One big discovery can send the stock prices flying. However, plenty never make it, so keep that in mind. This is not financial advice. And finally, we have the third group, royalty and streaming companies. No, not that type of royalty, although I'm sure they do appreciate the nice jewels on their crown. These royalty and streaming companies are a little different. They don't actually mine for the gold themselves. Instead, they finance projects, and in exchange they get royalties, meaning a future percentage of production in the case of royalty companies, or streaming deals in the case of streaming companies, where they get to buy gold at a fixed discounted price, of course, to then sell on the open market. What's the beauty of this model? Well, they get exposure to gold prices without all the messy, explosive risks of actually running a mine. But there's one more thing. If you don't want to pick individual companies for whatever reason, and that's fair enough if you're not ready, if you don't have the knowledge, you can always go the more simple one-click approach and buy a mining ETF or a mutual fund. That way you're instantly diversified across a basket of mining stocks without betting it all in just one company. And a mutual fund is professionally managed, but the fees are higher than that of an ETF. Now, how does this all tie back to gold?